Simon Collins heads Non-Ferrous and bulk commodities at Trafigura. He joins us today to discuss metal demand, supply and prices. Simon, good morning.
Good morning.
Now, Simon, metal prices are down and stocks are increasing. Is this cyclical or structural?
I think what we're seeing is a cyclical downturn in the market at the moment. We seem to have a hangover from, I would say, 2008 and the events that occurred during the global financial crisis. You've had a high and an increasing elevated stock level of certain metals, particularly aluminium and zinc, and now we're starting to see stocks increase for copper as well. I think we can put this down to a couple of factors really. Firstly is that higher prices over the last few years have brought more supply to the market, as we would expect, and also we're seeing moderating demand in Europe and the US as well as China.
This China's soft landing, but it's going to pick up, isn't it? Markets
are still growing, and China is occupying a very large portion of both global supply in terms of metal production and global demand. Depending on metals, can be anything from 35 to 40% of global demand. So their impact on the market is quite significant. As I mentioned, the markets are still growing, but what we're seeing is that rather than it growing somewhere between 10 and 15%, we're looking at levels which are closer to sort of 8 to 10%.
How are metal prices formed, and who gets the lion's share?
The negotiation between the mining companies and the smelters have traditionally been characterized by the mining company giving the smelter a discount to the final metal price. This is also sometimes referred to as a treatment charge or processing fee. Processing fees in the last, say, decade have been extremely low, meaning that the income of the mining company has been far higher compared to that of the smelter. I think the reason for this is because the supply has been relatively tight, demand very strong, yet at the same time the smelting capacity has been increasing rapidly, particularly in China. Going forwards, we'll have to see what happens, but we're starting to see that mines are performing very well, and demand, as I mentioned earlier, is moderating. So we may see some change in that balance between the income to the miner and the smelter.
And what about the logistics and shipping aspects?
Well, shipping market is still appears to be in distress. We see an oversupply of ships generally in the market, and prices for all classes of vessels are very depressed. In our view, we don't see that recovering in the near term when we look at new build capacity and the outlook for growth generally.
Moving on to the financial aspect, the recent study by UNCTAD has pointed out that 2/3 of commodity price volatility is due to financial trading. They even conclude, I believe, that financial trading distorts or makes price formation less efficient. What do you think of this statement?
Well, I haven't read the report myself, but what I can tell you is that in the 90s and early 2000s, we saw price volatility as being relatively moderate, somewhere between 10 and 20%, depending on the commodity. As markets picked up, then volatility has also increased, and we saw increases in volatility coming to anything between 35, 45% for a number of metals. Now that we see the markets in a lower end of the cycle with demand moderating, then volatility is dropping again. At the same time, the exchange traded volumes are still very, very large. So there's still a lot of interest in the market from both producers, consumers and speculators. But it's hard to conclude that volatility is created from the speculative element. It seems to be more market driven aspect in terms of what is the fundamental balance between demand and supply. The only final comment I would make is related to the volatility between exchange traded products and non-exchange traded products. And historically we've seen that non-exchange traded products can be far more volatile than exchange traded products, because simply when there's supply and there's no buyer, then the prices drop significantly. When there's demand and there's no additional supply through any stocking, which tends to be the way for exchange traded products, then prices can increase by 100, 200%.
Simon, thank you very much for joining us today.
My pleasure. Thank you.